All right, guys. So we've got Avery Horton here from, well, otherwise known as the Rumpled One. Now he's going to walk us through what we've just gone through on a podcast. He's spoken about three different kind of zones that he uses in his trading and has done so for many years. So welcome to the Trading Nut YouTube channel here, Avery. I'm going to leave it with you to walk us through these zones and show the guys how they work.
Okay, well, I will. Okay, there we go. Yeah, I made a little screen for you there.
Cool.
But I always talk about money and risk management first because you don't want to lose any more than you're willing to lose per trade. And you see, it's not complicated. If you know where your stop loss is, you calculate your position size. If you want to use the same position, your stop loss is always going to be the same distance away from a trade. Now, first thing is I mentioned the weekly gap, and you can see here that the dollar yen opened here, which was above the close. So there's the open, there's the close. It was about 6 pips. So that was the trade.
Right.
And I guess you can see it here. All of the gaps filled for all of the pairs. Like the first trade of the week. Now, I mentioned frequency distributions. So in this particular case, this is the dollar yen on the daily. So the difference is greater than 0 100% at a time, range being high minus low. It's greater than 10 100% at a time. This is over the last 100 bars. Now you see here over 20, 96, over 30, 76, over 40, 53%. So this is what I call my frequency distribution display. And it allows you to do a lot of different things. So you can use these are all the different options you can put in there and to run frequency distributions to see whether or not your idea makes any sense. So like right here, the maximum is 174 pips, the minimum 11, the mean or average 48, the median value here 41, and the mode 48. So once again, I have a background in statistics, so I know all these things. So for a buy zone trade, it's obvious that price moves, but okay, that's high minus open. So if you were to do a buy zone trade with high minus open, you can see here 22 times it was between 0 and 9. Okay, and I can move this out of the way. Okay, good. 20 times or 18 times it was between 20 and 29 pips. Okay, and so you can see here, if you set your buy zone at say 10, and about 78% of the time, your trade's going to trigger. And you can see where it makes sense to start taking profit.
And where would you put that? Where would you enter that trade?
Okay, let's see. Let me go to this screen that I set up. This is a 1-hour chart. Now, if we're going to do buy zone, there's an indicator I wrote, TROHL5, and that's free to download off of Crestlick.com. And one of the things people always yell at me about, well, you're just trying to drive traffic over there. I go, look, I'm a coder. You only keep your code in one place. So, because if I put it in 10 places, it's just more work for me. So that's why I don't do it. So let's see, shade. I know where it is. Open offset. So here I'm going to have an open offset of 10 pips. So right here, you've got the buy zone and you got the sell zone.
Okay.
So right here, if it hits this line, you buy.
Right.
If it hits this line, you sell.
Right. Okay.
So it's not really that difficult. So like, let's see, we can break it down to like here's the daily low. So if you were trading off the daily low, where would you pick up that trade? Okay. Now I'm going to tell you something. This is not a secret, but people that talk about trends and all this, every move off a bottom is going to have a red candle followed by a green candle. There's no other. Once you see that pattern, that could be the low. But you go back and you can do it on a daily chart too. So as I was saying, we can even go to M30. You see here this bottom, red followed by green.
Yep.
And so that right there, put in the bottom, this could be the start of something big. Now you look at the top, green followed by red. That's the pattern you look for. So like here, green followed by red. Did it break it? No. Did it break it? Yes. So that's what I call turn trade. But that's just one of the things where you can just use your eyes. I mean, and you can, if you want to, you can look at the daily. It's the same thing. Red followed by green. What happened next? You can go to the weekly. Here at the top, green followed by red. What happened? Green followed by red. At the bottom, red followed by green. Red followed by green. One of these is going to be it.
Yeah.
Which one is going to be the it? Yeah. But another secret, and this gets back to the wicks. You see this candle right here? It barely had any wick, but you see what happened here? It went down, it came back up. And it's kind of like, well, wait a minute. It did it once, it did it twice. It's doing it again. That's why I say this stuff is not that difficult. Now, but let's go back to the buy zone. So right here, we've got the buy zone. We got the short zone, the triggers. So right here, that would have been the trigger. So you put your entry there. Now, if price closes below the open, you might want to stop. But if it hits this line, you definitely want to stop. So you have to decide, do I want to do I want to put my stop at a tight place or do I want to leave it loose? So if this was 1 unit here, then this would be a half unit, or 2 units, 1 unit, because it's roughly the same distance. And then where do you take profit? There's many different ways. But you see here, in this particular case, because you don't know what's going to happen next, there's a wick. Let me make that a little bit bigger. You've got this wick, and if price closes, actually it exited that wick, you might want to take it there, or if it closed below that wick, you want to be out. So for example, here, if you were long, you're long, okay, it's coming down. It's just like, wait a minute, it's telling me right here, it's telling me price is going down. So just right there off of that wick, you can just look at it. I mean, we're talking price action here. So that's the buy zone. Now, since this is a great day, we can do the rat zone. So come on, computer, show high-low offset, true. And so right here, it says the offset's 20 pips. And so right here is the rat zones. So right here in this area, when price left it, you'd want to go short somewhere between the 38 and the 58.
Okay.
Okay, because once again, based on the okay, which one was it? It's this one, high minus close. 0 to 9, only 29 times. 10 to 19, 28. So right there, that's about 57 times would it be less than 20, okay, out of 100.
Yeah.
And so you see here, this is what I call the rat dot. So if you sold anywhere up in here, you'd be in profit right now.
Yeah. I'm with you.
And so like right here, the same thing is true. You can see where the dots are compared to the close. So on a green candle like this, if you would have gotten in that rat zone, there's probably no indication to sell. And this is on the daily time frame. But if we go back and we look here at this chart, you can see here, price was moving down. Now we can, change that over, say 15 minutes, and you can see it even better. So I have something I call the rat reversal. Green candle closes, red candle closes. At the low of the red candle, you go short. And that's how that works. Now we've got one more we talked about was the wick zone, but let me do a reset on that. So if you look at the daily from yesterday, you can see it was a doji.
Yeah.
Okay, let's just pick pound dollar since we talk about that a lot. So here's pound dollar, which is close to a doji. So you can see here's the candle top, here's the candle bottom. So it entered the upper wick zone, came out, and entered the lower wick zone and came out. And this is on a daily time frame, but if we drop it down to the H1 time frame, you can see all the action. And so, like I said, if price gets into this zone, about 77% of the time, it's coming out. Which side? I don't know. Doesn't matter because I'm just going to take the trade. So here, candles green, you go long. Candles red, you go short. Candle green, you go long. Candle red, you go short. Candle green, you go long. Candle red, you go short. And this is just based off of the previous day's highs and lows. And where the candle opens and closes, the top or bottom.
Okay, so if it's up in the top, there's 70% of the time or whatever it is, it's going to go short, or you've got an option to go short.
Yeah, it's going to leave this zone. I mean, we can pick. What's your favorite pair to trade?
GJ.
So, once again, it was in the upper wick zone. It was punching through, and it gave you all those opportunities. And so these numbers here just tell you how many pips away price is. But there's another thing I did because some people want to know, is there any gas left in the tank? Meaning, how far has it gone on its range? So if you show distance as ATR percentage, you can set that to true. And then which ATR do you like?
14's pretty good.
Okay. So now it tells you these levels from the open, the distance, okay? So this high was 131% of the ATR. Now, if I turn on, whoops,
You entered an order.
I hate when I just put an order in, I'm going to kill that, or I'll make money or lose money. Let me do this. Let me show the open price or the close price. Let me just show it for today. And so you see price is at 101% of the ATR.
Okay.
Okay. So now this is one of my favorite trades here, tell you the truth. You see H1 bars, when did it hit the high or low for the day? So this is in magenta saying, so the last bar was a high. So this means I'm going to start looking for shorts to reverse off of that. Mm-hmm. So in fact, it came down so far. This would be what I would call a, actually the highest open trade would be right here. So right now we're pretty much at the highest open for the day. the H1 highest open, I'd be looking to go short right around this level.
Okay, I see what you mean.
But I wouldn't do it now because H1 is green.
Yeah.
I'd have to wait for this candle to close. So once again, it's high minus the open and then high minus the close for the rat. So high minus open, that's the buy zone if you're trading away from the open. And then high minus close, close minus low if you're trading towards the open off the daily high and low. You see that?
Say that again.
Okay. This is high minus close. This is close minus low. So if you're trading away from the high, you want to know how far price is going to move away from that high. And so this is the frequency distribution. So there's a particular, this is still dollar yen. Let's see. So high minus close, you can see from 0 to 9, it only happens 6 times. From 10 to 19, 14. So 8 out of 10 times, or 4 out of 5 times, price is going to close below that red dot and above the green. And then on the green dot, it's going to do that, what's that, 77% of the time? So you can just look here and see how, and the dot, that's the last entry, because once it goes past there, the ship is sailed.
Yeah.
So you can see here just how many times price would have paid off if you took those trades.
Yeah, interesting, eh? Yeah, really, really good. Cool. Look, this has been most insightful, Avery. Look, thank you very much once again for coming on the show. Hopefully the guys have picked up a whole bunch of stuff from this. I sure have, and I think they probably need to watch through this video a few times to pick up the nuggets and really get their head around it. But is there any last sort of words? Do you want to let the guys know how they can get hold of you again?
Well, my Gmail account is therumpled1@gmail.com. You could go to the Facebook page, Facebook group, The Rumpled One, and you can go to YouTube, The Rumpled One. I've got a Twitter account. therumpled1.com is a blog, and those pretty much just all take you to the videos. But, you know, I'm pretty easy to find on the internet. You can, like I said, my email and the Facebook group, and of course the YouTube videos.
Cool, brilliant. Well, look, guys, if you do want to get additional information to what we've just discussed here in the video, then head over to the podcast as well. So we've done an hour-long interview with Avery, and look, we go into all sorts of stuff and really sort of explains a lot of the thinking behind the wick, rat, and buy zones. So if you want to find out more about that, head over there. There should be a link under this video. Once again, thank you very much for coming on the show, and you'll get to find out why he's called the Rumpled One as well at the end of the podcast. All right, guys. Thanks a lot. Cheers. Bye.